So Jerome Powell just finished talking, and if you're anything like me, we don't understand what he just said, but we want to get what he said basically and see what it means and what it means for the market. Well, join me on this journey as we analyze exactly what he was trying to point out with the entire talks and all the talks about different things. Let's go down. So what I did was I went to download his video through it in a transcriber, got the transcript, and this is the transcript in the way it is. The labor market remains near maximum blah 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 blah. I don't know how to read this whole story, it's a lot. What I did next is I took this whole story and dumped it into Copilot, and told Copilot, attached is a caption of what I script about Jerome Powell's speech today, his recent talk on the Jackson Hole Symposium. I don't know if that word is correct, symposium. And I want you to tell me what sentiment he talks about, his talk brings about to the market and the economy at large, especially for US economy. Also, check the internet to fact check and get better information on the topic. So it's not just going to rely on just what I fed it. It is also going to go to the internet, and maybe someone else has posted something close. It's going to take it, put it all together with my caption, and then give us an information. So it gave us this whole stuff. I want the computer to read it for us. It's not long. I think it's about 2 to 3 minutes to read. So the computer may not be able to read it well from here. Hence, I put it into Microsoft Word. So let's call on Microsoft Word to read the entire statement.
Overall sentiment, cautious dovishness with inflation watch. Powell's tone today at Jackson Hole was measured, leaning slightly dovish compared to earlier in the year, but still underscored by a watchful eye on inflation. Dovish elements. Acknowledge that the balance of risks is shifting, with downside risks to employment rising and the labor market in a curious kind of balance due to slowing supply and demand for workers. Policy rate is now closer to neutral than a year ago, giving the Fed more room to adjust if needed. Dropping the 2020 average inflation targeting framework in favor of a more traditional flexible inflation target, signaling a return to a simpler, more predictable policy stance. Hawkish cautions. Inflation risks remain tilted to the upside, especially from higher tariffs and tighter immigration policy that could slow labor force growth and push up prices. Explicitly stated the Fed will not allow a one-time price level increase to morph into an ongoing inflation problem. Bank market interpretation. Equities. Stocks initially wavered. The speech didn't deliver an outright promise of a September cut, but the acknowledgement of rising employment risks keeps rate cut hopes alive. Traders are now pricing in a higher probability of a 25 bps cut in September, though not a certainty. Bonds. Treasury yields dipped slightly on the dovish tilt, especially at the short end, reflecting expectations of policy easing. Dollar. The USD softened modestly as markets interpreted the remarks as opening the door to cuts, but the lack of a firm commitment limited the move. Crypto and risk assets. Crypto markets reacted more sharply, with Bitcoin and altcoins sliding amid fears Powell's caution means no aggressive easing in the near term. Chart increasing implications for the US economy. Short term. Powell is signaling readiness to act if labor market weakness accelerates. This is supportive for growth if downside risks materialize. However, the Fed remains constrained by sticky inflation, meaning any easing will be gradual. Medium term. The shift back to flexible inflation targeting could improve policy clarity and reduce market confusion seen under the 2020 framework. Tariffs and immigration policy changes are emerging as structural headwinds, potentially slowing productivity and labor force growth. Risk balance. Upside risk, inflation reacceleration from tariffs could delay cuts. Downside risk, a sudden labor market deterioration could force faster easing.
Okay, so we've heard from AI's basic, should I call it, summary of the whole talk. So in case you did not really still understand what the whole talk here is all about, let me just break it down in simple terms for anybody who can understand it easily. So what he's trying to say is the inflation in the US is like it's killing, right? The inflation is not bad, but it's killing. And the scare is if they cut interest rates, right? If they cut interest rates now, there will be a lot of borrowing, and then you get prices of things might fly up even higher, which is risky because if inflation makes people unable to purchase things and all that stuff. At the same time, they are seeing that there's less people applying for job and there's less job available also. Hence, it means the economy in terms of production is beginning to slack behind. Meaning, if people are not working, meaning, for example, if I'm not working, if I'm not earning and you are not earning, you will not be able to purchase things in the first place. And then if you're not purchasing things, producers will not produce things, and that will slow the economy down severely. So I think Jerome Powell is caught in a very tight spot. He's looking one at the inflation data and then at the jobs data, and those two things are very, very crucial. But nevertheless, it is something that from the whole situation, right? From the whole situation, it looks like he's leaning more for the job situation, because if you look at it in real in-depth, right? If things go up and people can afford it, then the inflation is not really a problem. But if things go up and people can't afford it, then there's a problem. So what do we mean? For example, prices of things are rising, but people are getting like lots of jobs, people are making money, people will still be able to afford some of those inflationary costs and everything. But in the case where the inflation is stagnant, but people are losing jobs, right? People are losing a lot of jobs. People will not even be able to afford the standards anymore, that they will fall into poverty, and there will be so much poverty in the economy. And if there's poverty in the economy, people will not buy things, because people do not buy things, producers would not see reasons to produce things, and demand has died, supply will follow. And if supply follows, the economy is not producing, and then GDP goes down and all that stuff. So focusing on the job is a very, very good idea. Let's see how this whole thing played out in the chart. I mean, from his speech, it seems like he's more focused on the job situation, and with focus on the job situation, obviously, the mindset here is there will be cuts in interest rates, meaning there will be people wanting to go and take the dollar right now. People who have investments there will want to pull out their investments from the dollar and put it into other places because the interest rates might fall. So let's see the chart. Okay, and woo, that is hard. That is hard. This is the dollar index, and the dollar index clearly tells us that there was a serious. I mean, let's put this into the 15 minutes chart. Whoop, there it is. 5 minutes chart. Oh, yep. 1 minute chart. Similar scenario. Yep, that was harsh. That was hard. So we saw the dollar softening, and people who have been looking at this chart saying, "Oh, it's finally going to the upside. It's finally going to the upside." Yeah, I think this is like a gotcha. That's what it looks like. But well, the dollar is not standing much anymore. You can see it's been crashing ever since the 14th of January. There's been more falls ever since then, and that was the tariff issue from Donald Trump and all that stuff, the wars against other economy and all that stuff. And then we saw a slight rise recently. The dollar started gaining momentum, and people were buying into it. It's not bad. I mean, we're just following price, following the situation of the market. And now we see it giving back that gains and going down. So people are basically looking at this level right now. This is the 97.55 and 97.1. People are looking at these levels right now, and if price starts to taper below this direction, comes back, there's a tendency it will keep crashing below and more crash. But the market tends to always bounce back a lot of times, and we hope it bounces back most times. But this is for a particular economy. Let's see the majors. Let's check out the majors, see what happens on the major. We're going to start with the Australian dollar, US dollar, and we dive into the 1 hour chart. Okay, so obviously when you see that the US dollar index crashes, right? If it crashes, it means across the board expect that the opposing currency is being bought and the US dollar is being sold. So in this case, the base currency, which is the Australian dollar, is gaining against the US dollar. So I expect to see similar things where the base currency is the opposite, is the other one, and then situations where the US dollar is the base, I expect to see selling. So this is just for the Australian dollar, US dollar. For the euro US dollar, that is some sudden rise. I mean, this gives room for more uprise. People who should be looking are looking at this zone right now, still looking at this supply zone. This is a good supply zone, but it has been mitigated, and price is beginning to see things like we may see price actually break above and retest and break above even further, and depends on the US economy and the situation in euro. We go back to the British pound US dollar. We're having similar scenario, very similar scenario. This level looks like something that price may still do the same thing with. Break above. This is what it's looking like it's gonna be happening pretty soon. But like I said, you are not just because the chart is printing it means you just dive in. You need to wait for the news. Economic data are still coming out every day. Economic data is coming out every day, and as more data comes out, you might be surprised inflation might just crash all of a sudden in the US, and well, the whole thing is going to just go the opposite direction again. Over here we see there was some push up, there was some good push up, but basically I don't think this push up is strong enough. I mean, this level right here is still very, very strong. If you put your eyes down here to the supply, this is the supply zone, and the supply zone is still quite strong. So against the New Zealand dollar, it seems like we may just be having a possible retest and push down, right? We may be having that scenario, but if we do not have this scenario, we have price break above this entire area right here, then what we may be seeing is price coming for a retest and then, you know, finding its way to the upside. This is what we may see going forward in the New Zealand dollar, and any of the two could happen. I mean, this is reality. You can't just look and see exactly what's going to happen. Over here in the US dollar against the Canadian dollar, we have price coming right into a demand area, a very, very strong demand area from what I see here. Price may just dive into the zone and move up, right? Price may do this, or it may, you know, push beyond, come back for a retest, and, you know, start to slide even further. And most of these things are just dependent on majorly the US economy, except for the Swiss franc. Now, this is one of the places you need to trade with the most amount of caution. I mean, the Swiss franc, this is by far one of the most stable currencies in the world. Like, this currency has been so stable and strong that you need to be extremely careful when you analyze this guy. Like, you need to really watch. Selling the Swiss franc is a risk move on its own. It doesn't matter who you're selling it against. It's a risk move on its own before you start to compare who you're selling it against. And looking at it right here, well, obviously with the situation, we expect more push to the downside, probably all the way to the 0.7979 levels. This is the clear expectation right now to the demand zones, and I don't think this demand zone should even hold water. I mean, comparing the fact that this is the Swiss franc, right? This is Swiss franc. I don't think it should hold any water. I think it should push below. And then come back for a retest to push even further. Well, this is the world. And then the last guy, well, this is the one guy that this is the one currency that if you are shorting, right? If you're shorting this currency, you need to like hit your chest and, you know, need to gag up and say yes, you're ready for what is going to happen, because this is actually very expensive to short in the first place. That's one, because of their rate changes. I mean, the Japanese yen rate change is so, like, the interest rate is very tiny, and then you're comparing that against the US dollar. That is, it's expensive in the first place to short this currency, right? It's expensive, but then you may be lucky, right? You catch like this big move right here from the supply zone. You can see the supply zone has been sitting right here. I think that's a weekly supply zone. That is a weekly supply zone. It's been sitting right here, and we saw price push away before. Today we've seen price push even further down. Put it in 1 hour, you can see that strong nosedive right there. So this is the situation of the market right now, and today is Friday, right? Today is Friday. Lots of big traders are closing trades, a lot of hedge funds are closing trades. So in my opinion, and for anybody who's trading right now, I don't think you should even have orders left in the market unless it's not like the US pair, right? If it's not a US order, then fine. But for US orders, I don't think you should leave it in the market for now, because in as much as this news just printed a one directional move, Monday we may have more news. Let's check that out. On Monday, what do we have? Put that for next week. Oh, sorry, that was this week. Put this out for next week. Okay, we have the employment levels, we have building permits, and we have new home sales. So there are still FOMC members speaking as we talk. There will be more news coming through. Okay, we have the consumer confidence, we have the manufacturing sales and other stuff. So let's see, next week there seems to be like no serious news for the US dollar. Okay, yeah, next week we have the GDP. So the GDP comes out next week. It may come out in a way that is extremely positive, and that would take the market the other direction instantly again also. So there's a lot, and it's not straightforward. So just be careful out there if you're trading the US dollar right now. Just be very careful. There's a very short period of time left in the market. I advise you, get off the charts, go enjoy your weekend, and have a great restful night. Enjoy yourself, sleep off. Monday we come back here and we'll continue this whole jibber jabber. Thank you for watching, and see you all maybe tomorrow or next when we do some market analysis. Peace.